principles. In today's content, I want to talk about how to develop an investment strategy, why it's important, and what are the steps when it comes to making an investment strategy. I've talked before on this channel about, being properly prepared, in case when we have economic downturns. And I wanted to take some time throughout this video to go over how to properly put together an investment strategy, because having an investment strategy, it really aims for you as an investor to be able to balance the risk and reward within your portfolio. And in today's economy, it's very important to pay attention to what strategy you have in today's economic conditions. There's so much going on when we think about just the supply chain issues throughout many parts of the world, and how inflation and just our the tightening of our monetary supply has really completely shifted a lot of demand. Definitely want to go over investment strategy and really discuss if you need to create one for the first time. If you already have one, look at what are some improvements you can make in today's climate, and also, if there's some adjustments that need to be made. So the very first aspect when it comes to an investment strategy is you have to understand your financial profile, your financial situation. When do you want to retire? What is your risk tolerance? What is your risk appetite? Are you a more riskier person in the market, or are you one that's more conservative and that doesn't want to take a lot of risk? What is your time horizon? Are you 30 years, 40 years, even 50 years from retirement? All of these different aspects are so important, because when you start to get into your investment strategy, this is going to completely impact what you decide to do. For example, if you have someone that's 30 years old and they're wanting to retire at 60 years old, that person may be able to take more risk and be able to invest more equities and stocks more than bonds, because if there is a bad year or even a bad few years, they're young enough to have enough time to work for them for the market to recover during down periods in the market, whereas someone that's maybe 50 years old and is wanting to retire at 60, they have to be more selective with their investment strategy, because they're getting closer to retirement and they may have to have more bond exposure, for example, something that may be more conservative, that's not as risky, because they're going to have to be relying on that money very soon when it comes to retirement. Now, the second aspect when it comes to your investment strategy is you have to decide how you want to allocate funds within your portfolio. This is most known as the targeted asset allocation. And all I mean by that is, for example, let's say someone decides to put 80% of their portfolio in stocks and 20% of their portfolio in bonds. All of that is saying is that if you have $100 that you're investing every month, $80 of that will go towards stocks and $20 of that will go towards bonds. So this just really allows you to understand the direction that you want to go within your portfolio. Investing is much like a roadmap. You have to strategically know what you want to allocate, and then you go from there with deciding exactly how you want to make those investments. But the third aspect of investment strategy is you want to understand what type of asset allocation mix you have. So there's many different components. As you can see here from this chart, it has a lot of different areas when it comes to your targeted asset mix. So you have conservative, like I mentioned, where a person is seeking to minimize fluctuations in market values. They're taking an income-oriented approach with some potential for capital appreciation. So a lot of these people are going to have a majority of their portfolio in bonds. Like I said, people that may be in retirement, they're getting very close to retirement. They don't want as much risk. But for someone that has more of aggressive growth, this is a person that's seeking aggressive growth. They can tolerate wide fluctuations in market values, especially over the short term. So a lot of what we're experiencing now is a lot of market volatility. A lot of people young like myself are not really worried, because we understand that we have at least 40 years before we decide we're going to have to rely on our retirement savings. So this chart is very good with understanding the different asset mixes, and as you develop your investment strategy it's important to understand how these different asset mixes can impact not only yourself but your family and just your investments over the long term. So I always like to look at these type of things to get a better understanding. Now, another aspect of why looking at the different type of asset mixes is so important is because you can analyze the historical returns of the different types of asset allocation mixes. So when I talk about, aggressive growth, balanced, conservative, if you look at this chart here, it really just shows the risk and reward, the returns, and also the volatility trade-offs. Everything has trade-offs in life, especially when it comes to investing. As you become, if you are more an aggressive investor, as you can see here all the way on the right-hand side, 162.89% was the highest one-year return. The lowest one-year return was negative 67.56%. And then the highest 5-year return was 36.12%. And the lowest 5-year return was 17.36%. And the average annual return was 9.93%. So as you can see with this type of strategy, when you're looking at your asset mix, the most aggressive, you're going to have a higher return, but there's also more risk. Whereas someone that's more on, let's just say the balance side, is less risk, but it's less reward. So as you can see, a person's putting 40% into bonds, 35% into stocks, 15% in international stocks. Their highest one-year return, 76.57%. Their lowest one-year return, 40.64%. And then as you can see, the highest 5-year return, 23.14%, and the lowest 5-year, negative 6.18%. And that average annual return is 7.92%. So you can kind of see this is a great indicator and a way to look at historical data. This is also from the time frame of 1926 to 2012, but you can really look at this and say, okay, what is my asset mix that I prefer based on my age, my time horizon, my risk tolerance, and kind of look at the historical data to see, okay, this is what it has done over time, and really have a perspective when it comes to picking that investment strategy. So I think that that's also important. And then really just the last step with your investment strategy is really deciding on your investment selections. So you've gotten to the point where you understand your targeted asset allocation. You have a better understanding of the historical returns when it comes to different asset mixes. And now it's the point where you actually have to decide, okay, do I want to invest in index funds or stocks? Whereas index funds allow you to be able to reduce your risk a lot more than investing in a single stock, because with an index fund, it mirrors a particular index and you're investing in a portfolio of stocks in one fund. Finding a great index fund that mirrors the performance of the overall stock market. So you have like total stock market index funds that will allow you to be able to get exposure to the entire stock market. And for those that are bond investors that are approaching retirement, you also have different bond index funds that will mirror the total bond market. So I definitely think index funds are a great way to get exposure, to be able to grow your investments over time. We'll also look at different sectors and say, do I want to get exposure to the technology sector? Do I want to look at consumer staples? Because right now, value, it has been, a lot of people have been looking at value and looking at companies that are going to have great balance sheets and that are not going to move as volatile with the tech sector. So that's one way you can look at it. But I definitely think when you are looking at your investment strategy, you have to first understand your financial profile, look at what your time horizon is, what your risk tolerance is, how long you're away from retirement. You also want to decide on your targeted asset allocation. Then you want to look at what are the different type of asset mixes and how have they done historically, really having a perspective on how your risk tolerance is going to tie in with the reward that you want within the market. And then lastly, really just doing that research and finding, what are those investment selections that I actually want in my portfolio? What are things that I have an interest in? So I thank you all so much for watching this video. If you can do me a huge favor, continue to like, subscribe, and share this video. Don't forget to hit that notification bell below so you can be notified each week when I drop content. And thank you all for watching, and take care.